Let's move on here and talk to Harrison Johnson, our CFP. He's here with us now, financial planning. I saw this here. Is Social Security now tax-free? I thought it was kind of tax-free before. It wasn't. I mean, so kind of clear the waters here for us.
Yeah, this was one of the big questions with this tax bill that now was signed last week. So in a short answer, is Social Security now tax-free? No, it's not. Social Security is still potentially taxable. Before the law was passed, most states do not tax Social Security. California doesn't tax it. There are like 7 or 8 that do, but most states do not tax it. So it's only a federal thing, which the law was a federal law. On the federal side, between 0 and 85% of your Social Security benefits are reportable as income. That ratio is based on the other income that you have. So the more other income that you have, the more your Social Security is going to be reportable, and that has not changed. So somewhere between 0 and 85% of whatever Social Security benefits you receive is going to be reportable on your tax return. So that didn't change at all. But what did change that kind of offsets that in a way is the standard deduction has been increased, and this is as of 2025. So this tax year, 2025, and it's going to, this portion only lasts for 4 tax years. Standard deduction is increasing. So for a married couple, before this law change, the standard deduction this year would have been $30,000. So across the board, all married filing jointly tax filers are receiving a $1,500 increase. And then for people who are 65, before this, if you're a married couple, you got an extra $3,200 deduction. And now on top of that, you get an extra up to $12,000 deduction if you're over 65. So now 2025, if you're over 65, married filing jointly, your standard deduction can be as high as $46,700. Pretty large.
It is quite large.
That to me is better than getting Social Security tax-free.
Well, and then I'm thinking too, is like 65, like I don't want my Social Security yet. You still get that standard deduction of, what do you say, 46,000?
Yeah, so it's up to 46,700, and you're 65 or older, and that it's a deduction against all income. So right. Social Security, interest, dividends, capital gains, IRA distribution, any ordinary income source that you have. And the interesting part about this is it's basically $6,000 per person if you're 65 or older. So a married couple right. gets $12,000. That deduction exists even if you itemize. So it's not included in the standard deduction itself. It's an above-the-line deduction. So whether you claim the standard deduction or if you itemize, because itemized deductions now potentially will come back with the increase in the SALT limit, you could also get this $6,000 to $12,000 deduction even by itemizing.
And if you start collecting Social Security at 63 early, you don't get that deduction, so you still pay the same as before.
You still pay right. the same, and again, the Social Security itself is still reportable. So if you had between a married couple, $60,000, which means at most about $51,000 of it would actually be reportable. That's 85%. That's still going to be reportable. But that's a part of your gross income. Your gross income is then reduced by these deductions, standard deduction, itemized deduction, this extra $12,000 deduction that brings down your taxable income, and then your taxable income is, gets applied to the tax brackets. So 65 or older, you get this extra deduction. Overall, some people this will help more. Some people would have been helped more by having no taxes on Social Security, but there's a lot of people out there, even before this, who didn't pay taxes on Social Security, because their income was low enough where 0% of the benefits were taxable, or there's also people where even where they had Social Security that was taxable, the existing standard deduction or itemized deduction at the time was large enough to completely offset it, bringing their taxable income down to 0. So now this extra deduction could just, further reduce taxable income, meaning more people will either have a lower effective tax rate on their Social Security or potentially have it be tax-free.
And the thing I look at, the reason I say I think it's better than getting Social Security tax-free is it enables you, if you know the rules, to plan accordingly. So I'm just kind of throw out a scenario here. Maybe you don't collect Social Security at 65. Maybe you work at doing Roth conversions during that time period, then start collecting Social Security in a couple of years, and then, again, depends on your situation, but then your lower tax liability, or your tax liability, essentially shrinks over your lifetime. I mean, I think it enables you to be more flexible by having that higher standard deduction rather than getting no tax on Social Security.
It's definitely going to be more complicated.
Yeah.
And what I mean by that is this extra $6,000 to $12,000 deduction, whether you're single or married, there are income phase outs for that begin at, if you're married, an adjusted gross income or a modified adjusted gross income of $150,000, and then it's totally phased out by $250,000, again, for married filers. So what that means is if your gross income is $150 and now you get this $46,700 standard deduction or deduction, basically what that means is your taxable income is going to fill up all of the room in the 10 and the 12% tax brackets. You'll barely spill into the next one, the 22% bracket. However, where it gets a little dicey there is if you then do Roth conversions on top of an adjusted gross income of 150, like one of the popular thresholds that people try to hit is, they'll fill up as much room as they can without triggering any IRMA. That happens right now at a taxable income of like 220. Well, if you increase your taxable income up to that level, you might be in that 22% bracket, might not hit IRMA, but now that deduction, instead of getting a $12,000 deduction because your AGI is higher, now you only get like a $3,000 deduction or whatever it is because of that phase out. So you're not only taxed then on the conversion that you did to fill up the room in that tax bracket, but now your taxable income is also larger because of the loss of that deduction that you have. So it's going to be, I think it's going to make my job more complicated to kind of navigate this and tell people what to do, because there's all this nuance where you make this one decision that has an influence on your income, but then there's all this ripple effect where it affects income in other ways.
And then throw one other kink into the equation, and that is the fact that this is not permanent, right?
It's not permanent. So it's only 4 tax years.
Yeah.
So 25, 26, 27, and 28. Other things are permanent. Like another thing that will have an influence on the overall Social Security taxation is the fact that the tax rates themselves are not increasing. They were expected to sunset at the beginning of 2026, meaning the tax brackets right now, they're 10, 12, 22, 24, 32, 35, 37. They were going to increase to 10, 15, 25, 28, 33, 35, 39.6. So there was going to be an increase to the tax rates that are applied to your taxable income. Now that increase is no longer happening. So with Social Security, even though the Social Security itself is potentially income, you get a larger deduction, bringing your taxable income down, and then that remaining reduced taxable income is now going to be taxed at a lower effective rate because of the not increasing of the tax rates. So a lot going on here. Overall, there are people who would have been benefited if all of their Social Security was tax-free. Again, if you had, $50,000 a year of taxable Social Security, if that was all tax-free, that'd be like a $50,000 deduction. Yeah. The deduction now is not that high, but now there's other people who don't have that much Social Security or who are not taxed on it anyway. And now this extra deduction offsets other income. So it's going to be something where it needs to be navigated, but that's part of the fun of it, I guess.
Yeah, and this is why, financial planning, true financial planning like you do, has become so important for people because it's so complicated now. And this affects that and so forth. So this is why you need to visit a fee-based financial planner, which Harrison is, because you're lost without it. People make the wrong decision. If you go to a financial planner that does investing and financial planning, you're probably not getting the full scoop. So Harrison, thank you very much. We appreciate it. You want a free consultation with Harrison, go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Or give him a call directly at the office, 858-224-0004. Again, that's 858-224-0004. And again, Harrison Johnson, free consultation. It is just so confusing, these new tax laws. And the CPAs don't really do a good job. They know the tax side, but they don't think about how it affects the investment side.
Well, many times they look at, and some CPAs do tax planning, but a lot of CPAs don't. They'll do tax filing. So they'll look at, in this case, when you file your taxes in 2026, they'll look at what happened in tax year 2025 and not think about, well, what's going to happen in tax year 2026, 2027, 2028, 2030, or not 2020, right. 2030, 2030. And that is what a true financial planner does, is look at your long-term tax liability, not just your tax liability from the most recent tax year.
But the other thing CPAs don't do is they don't look at the opportunity cost of the investments. They always look at the tax side. Harrison looks at both sides. We do this is going to happen here. It's going to be good on taxes, but it hurt your investment side. So that's why a good financial planner is that really knows taxes and investing. Great tool. Give him a call, 858-224-0004.